Hello and welcome. Renee with EBI Partners. I've got Don Thornton, Infinite Wealth Strategist, here today to talk about an amazing tax strategy that you don't know about. Don, tell me about your background. How did you learn about a strategy like this?
Well, first of all, I'm in real estate investing. I've been one of the country's leading short sale investor for 20 years. And I can tell you that if we, use a leaky bucket as a metaphor for a business that is running but is paying way too much out that it needs to, in my case, it was taxes. Taxes were always by far the biggest suck of my hard-earned money out of my bucket because I did not have a tax strategy that worked because I was making a lot of money flipping houses and one until it got to the point where about I don't know a couple of years ago, not quite 2 years ago, I found out from someone who had heard about another real estate investor, and he told me I was doing everything wrong, and that if I was ready to stop, paying money to the IRS, I didn't need to, and carrying these big liability policies because I was always afraid of someone, suing me if someone, slipped off a ladder doing a rehab or someone did a slip and fall scam in front of the house that I was rehabbing, that, I'd be a target. So, he said, look at this. And I looked at it and it was as if I was an illiterate person who learned to read for the first time. That's how powerful it was to me.
Huh.
And I realized that, yeah, he was right. I was doing everything wrong. And so, I realized I can't go back and change the past. All I can do is change the future. So I decided that I wanted to adopt the strategy, and it's been awesome.
Awesome. So a lot of people ask questions about how do you legally reduce your taxes to next to nothing. That's what I hear the most when mentioning the strategy. How do you do that
Well,
legally?
it's actually very simple. And I think people sometimes overcomplicate it. So I'll keep it at a very basic level. Let's say that in a year, my company generates $1.5 million worth of gross revenue.
Okay.
So what you do is you get rid of all the expenses and everything you can deduct. You do. And so let's say that our net income, our pre-tax net income, is $1 million.
Okay.
Normally, I would pay 32% on that because that's considered ordinary income because I didn't have capital gains taxes. I was just ordinary income, like a 1099 person would be. A business owner would have that. It's all the same thing. And so, if you have more than $165,000 of ordinary income, that's taxed at 32%. So basically, I had the IRS as a third partner in my business that contributed absolutely nothing, but was taking a third of my profit. So, so remember that without this strategy, I'd be having to pay right around $320,000 out of $1 million worth of net income, pre-tax net income. So that's a big chunk. So in this strategy, that's almost all of it's wiped away. So here's how we do it. We create what we call a beneficial trust.
Mm-hmm.
And this trust has two main purposes. And the first one, of course, is it's going to protect you from lawsuits. It has been around for over 100 years, if not more than that. And it's never been penetrated. The only way that the government or attorneys, anyone can penetrate it is if they can prove that you were doing fraudulent activity. But since obviously we're not going to be doing fraudulent activity, then you can not be worried about that. So you put your personal and your business assets into the beneficial trust. You're locking them in a steel vault of impenetrability for asset protection. And also, this trust works in conjunction with IRS Code 643B, which gives you amazing tax breaks. And it's, in a nutshell, what it does is, and I'll show you how we're going to do this. But basically, we're going to convert most of that $1 million of net income that's ordinary active income. We're going to convert it into permanently tax deferred passive income.
Okay. Active income into passive income.
Yeah, we're going to convert it to passive income. So the way you do this is very simple. If all of your business's assets are in the beneficial trust, then you have to run your business somehow, because you're not running your business anymore officially, because you don't want to be vulnerable to lawsuits.
Mhm.
So you either have to do an LLC or do a business trust. Okay?
Right. That's what I'm used to, the LLC or the business trust.
Right. So I mean, it depends on. I mean, a lot of people, for some people, the initial investment is a little bit too much, and they want to work up to a business trust. And that's fine. Personally, I do a business trust because I wanted to make sure I had ironclad asset protection for the entire strategy. But for
Yes.
some people, they just can't afford it, and that's fine. We get it. You can do it with an LLC.
Mhm.
So regardless of whether it's an LLC or a business trust, this entity will be the one running the business, but it needs to have assets to run those businesses.
Okay.
That business and the assets are in the beneficial trust. So what we do is we get the beneficial trust is going to lease those assets to this other entity, either the business trust or an LLC.
Oh, okay.
That allows me as trustee or as general manager, general owner of the LLC, allows me to run the business and create revenue. So in this scenario where $1 million is the net income,
Mhm.
right? What we can do now is we can take 70% of that, which is $700,000, and we can transfer that over to the beneficial trust as a lease payment, which is considered passive income. Which
Oh,
means
okay.
we have taken $700,000 that the IRS had their sights on. They
Mhm.
wanted to get that. It's off the table. It's
Mhm.
now over here, protected from lawsuits, and it's tax deferred. It never has to, taxes are never paid on it. Okay,
Okay.
so that leaves $300,000
Right.
left over. Which, even if that was just that, it would be a great thing, because you're saving a lot of money on taxes. But we can get it down even farther than that.
Oh,
So
nice.
when the LLC or the business trust is formed,
Mhm.
the beneficial trust is a 90% limited partner in that entity. Okay.
Okay.
So at the end of the fiscal year, the beneficial trust needs to be paid for its equity position.
Right.
So they get 90% of whatever's left over. So $300,000 is left over
Mhm.
after we sent that 700,000 over. So now we take 90% of that, or $270,000, and we send that over to the beneficial trust as a K1 disbursement.
K1 disbursement.
Right, which is also considered passive income. So now this entity, the beneficial trust, excuse me, the business trust or the LLC, is just left with $30,000 of income to be calculated for taxes. And you know that $30,000 is nothing, and no one, what tax are you going to pay off of that money?
It's pretty remarkable.
Right. So that, in a nutshell, is how it works, and it's genius in its simplicity.
Mhm. Wow. I'm glad that you kind of put it in that quick walkthrough. Like, talk about the costs. I know a lot of business owners, and I know that their biggest heartburn is paying taxes,
Right.
and they're trying to do anything that they can to reduce their taxes.
Right.
We are big on return on investments. Obviously, if something costs something, how long does it take to make that back?
Yeah.
In this case, can you talk about that a little bit?
Sure. The additional investment is depends on what your choice is, of course, for how you want to set your infrastructure up. If you want the beneficial trust, that's the linchpin. You have to have the beneficial trust. The strategy does not work without that. That's $15,000 investment one time, and that does include an entire year's worth of consulting with our accounting company that's affiliated with us, and they'll even do your taxes for the first year as part of the $15,000 investment.
Well, that's kind of a saving grace, because I think that anybody that would be interested in something like this would be a little leery about their existing accountant understanding the nuances of this strategy. Right. That's helpful. So it's $15,000 one time forever, one time per year.
Yes, and then it's up to you. Personally, I chose the business trust because I wanted to make sure that the umbrella of asset protection was around that as well. You're a little vulnerable if you run it through an LLC, because remember, there's no asset protection there. Anybody who wants to go after that LLC can go after it, including future earnings. So they can do liens, encumbrances. They can garnish or seize future earnings with an LLC. So the money that gets from the LLC to the trust is completely safe.
Is that because of contract law versus Like,
Yeah, I mean, anything that I'm not going to get deep in the weeds about this, but basically, the trusts are set up under contract law, which is guaranteed by the Supreme Court. I think the earliest decision that was made by the Supreme Court was in 1810, believe it or not. And so, this particular kind of special trust is covered under that ruling, and so it's settled law. It's the government has no right to tax or otherwise get in the way of a contract between two entities. Okay,
okay.
whereas the legislative law is when the government, the legislature, the Congress, if it's federal or state, city council, whatever, they create something. That means whatever they create, they can change or eliminate, and you can basically have the rug pulled out from under you without.
Right.
Yeah.
And
Whereas,
that's why an LLC provides less protection as far as your assets are concerned, correct?
yes, and income, so
And income.
they can seize your income. So basically, you have kind of like what I call a halfway pregnant scenario here, where when you get the money over here to the beneficial trust, it's completely safe. But what about during that tax year? And your money's moving in there and so forth. As long as that money's sitting in an LLC's account, or you've got property in the name of that LLC, they're vulnerable. So it's better to do the business trust, but if you can't do it, at the very minimum, get the beneficial trust and use the LLC temporarily until the tax savings you're going to make on that will justify you purchasing the business trust, which would cost $20,000 additionally.
Okay. So we're at 15 initially, correct? And
Right.
then
20 more if you want the business trust or not. So,
and you could use an LLC, which has less protection, or you could add on the additional
business trust for additional $20,000 investment. Yes.
For 100% lawsuit proof.
100% lawsuit proof. Yeah, exactly.
Asset protection.
Yes, that's the main thing that's missing when using LLC is that you're just still vulnerable from an asset protection side.
Right. And one of the last things that caught my eye was, I'm thinking about like restaurant owners, business owners turning their active income into passive income. I know that asset protection is paramount for the business owners that I know. And I feel like that passive income becomes really desirable during this strategy.
It is, but only if you have a beneficial trust.
Oh, that's true, because the LLC won't protect
you. These tax advantages are only if you have a beneficial trust. I mean, if let's say you had an LLC, over here, or over here, I guess, and then you had an S corp over here, right? If you were doing the same,
many of my business owner friends bragged about the S corporation, especially if they were getting a divorce or something like that.
No, you don't get the tax advantages because the S corp does not have any tax advantages like the beneficial trust has. The linchpin of the beneficial trust is that passive income in the form of a lease payment, for example, or a K-1 distribution, that can be deferred in perpetuity because of the nature of the trust and what it is allowed to do by IRS 643B. And of course, capital gains, which we haven't talked about, which is mostly a real estate investing or a business who sells a business owner who sells a business, obviously is going to pay capital gains as well. Or honestly, crypto investors. Yeah, anyone who gets any kind of capital gains, period.
That's huge. Crypto they're really looking for strategies.
Right. Right. So so basically, the turning it from active to ordinary income to passive income is only worth it if you have the beneficial trust that gives you the ability to defer that in perpetuity.
Excellent. I thank you for your time today, and I want to invite anybody who is interested in learning more about this strategy, or if they're interested in learning how this strategy can help their business, their specific industry, you can go over to assetprotection.now.site, assetprotection.now.site. You can see it on the ticker below. If you are interested in this strategy, I would love to connect you with Don Thornton, this infinite wealth strategist. We didn't really even talk about any sort of banking. So I think that the next time we meet up, maybe
we'll talk about how we can set up your own bank and all this tax savings you're getting from this strategy. We can put a lot of that into your own bank, and your head's gonna explode when you hear about that.
Yeah, I hope that we get a chance to talk about that really soon. So thank you so much for your time. Really appreciate it. And again, Thank you to Don Thornton, the Infinite Wealth Strategist, for letting us know about this tax and asset protection strategy that only
Thanks
the
for having
ultra
me.
rich know about.
Yes.
Thank you. Bye, Don.
Thank you.